touch on that I made a mistake. So I made a mistake with two things. So please note these two mistakes that I made. So the first one, I think it was Lungi. Thanks for that, by the way. Alerted me that the lease premium, don't forget, the lease premium has to be apportioned. We did cover that one, but I just wanted to say it again that I made a mistake there. So the lease premium, you have to apportion it, although we did correct it in the session. And then this is the second and last mistakes, and please take note of it. You remember the recoupment, right? I said the formula for recoupment is selling price limited to cost minus allowances, right? And that's not the real form. The formula, it's supposed to be minus tax value, right? It's minus tax value, not minus allowances. So for the selling price, we are correct by saying it's 4.1 million, right? But it's not minus allowances, so it's not minus that 3.5 million, right? We are just going to say tax value minus tax value. And what is the tax value? The tax value is the cost minus allowances, right? So it's cost minus allowances. So it's going to be 4.1 million minus the 3.5, and that gives us the 600,000, right? But the 600,000, what is it? That's the tax value, right? So we are finally, so the final answer, we are going to say it's 4.1 million, right? So it's 4.1 million minus 600,000, and that gives us 3.5 million. And that is our recoupment. And that is our recoupment. So that gives us 3.5 million. That's our recoupment. Then all the rules that I said after then, like they apply the same way. So you're still going to take this amount and multiply it by 5%. You remember that 5% because the recoupment is deferral. So you're not going to multiply that 5% to the 600,000 that I said in the last video. You're going to multiply it by this 3.5, because what is recoupment? Recoupment, you are recouping your allowances. That's the main rule of recoupment. So do you see, you recoup that 3.5 million. So that's the main rule of recoupment. So you are recouping back allowances. SARS wants the allowances back. Why? Because you are selling the asset. They gave you that relief, but they want the allowances back. So that's those are the two things I wanted to touch on. Before I move on, do you have any questions there? Any questions about last session, with regards to last session? Okay. Okay. I think we can move on. Okay, let's move on to number 7. So number 7, it's administrative and other expensive. So it says all of the amounts mentioned below are accounted for as part of administration and other expenses for accounting purposes, right? So we know that they're accounted for as administration and other expenses. So 7.1, JJ made the following payments relating to the period mentioned below, right? So the first payment is insurance premium. So insurance premium paid for the period of when, starting, like I said, we are reading the date the same way. Like I said, we are supposed to read the date, right? So it's, you pay the insurance premium 10 months into the year. Do you see? So this insurance premium was paid for 2 months in this year, then up to what? Up to 30 April. So do you see that there's a prepayment? Ne? We have to take note of that. There's a prepayment that happened because it's up to 30 April 2023, right? Then we move on to the next one. The next one is say security fees paid to secure this for guards for the period of so for the period 1 June 2020, which is 11 months into the year, to 30 November 2020, that is 4 months. So 4 months into the next year, right? That's November 2022. So even this one, it has a prepayment, do you see? Because we are paying for expenses right? Or for services that we are going to receive next year, right? Next financial year. That's why when we started with the MM approach, when we started with the MM approach, we said perspective is very important. So perspective and date is very important. I hope you wrote this approach down, because it's very important. It's very important to know what date you are at and who you are. So who you are is also very important. Then, okay, let me go back there. Okay, then let's talk about the insurance premium. So what's going to happen? The first thing we are going to do is, that 6.5 for both accounting and tax. We are going to record that 6.5 times 2, so 13,000 for this year, right? Because accounting and tax will account for these insurance premiums the same. So you're just going to say insurance premium for this year, and that is zero. Why? Because tax and accounting accounts for them the same. Now we're moving on, right? There are rules to prepaid expenditure. So the rules for prepaid expenditure are found in section 23H, right? Rules for prepaid expenditure. So the first one is that the goods and services must be supplied within 6 months, right? Then it's allowed as a deduction. So let's look at this insurance premium. Do you see that in total, these services are not for 6 months? Because let's count from June 20, so from 30 June 2020 to 30 April 2023. How many months is that? So it's July, August, September, October, November, December. Yeah, it's more than 6 months, right? So that means that it won't be allowed as a deduction according to that rule. And we are doing question 1. We are at number 7 now. So question 1, number 7. Yeah. Okay, sorry about that. Okay. So the insurance premium, so that prepaid expenditure, you see that it's for more than 6 months. So we won't remove it as a deduction, right? Then you look at the next rule. Is it part of is there any legislation tied to it, like any legislation imposed to pay that insurance premium? No, there isn't, right? So you don't remove that. So do you see that we have 65,000 so far, right? That we have as a prepayment that's not allowed as a deduction. Okay, we move on. We go to the security fees paid. So that 65,000, just have it like on the side for like reserve, like as a side note, like as a reserve, because you're gonna have to compare it with other prepayments to see whether in aggregate they amount to 100,000, right? So let's move on to security fees. So these security fees that are paid, do you see that these security services are within 4 months? Do you see? It's 4 months. So it's within that 6-month period. So which means they will be allowed as a deduction according to that prepayment rule expense. Then let's go back to the 65,000. Do you see that the 65,000 is the only amount, right? That's not included in the, and 65,000, there is no other prepayments here. So 65,000 is less than 100,000. So you're gonna include it also as a deduction. So it is also deduction according to that 100,000 rule. However, if there was another prepayment, like the one like for insurance, so it may not be insurance, but it doesn't meet those two rules. So the one for legislation and the one for 6 months, right? And let's say that amount maybe was let's say it was 50,000. Do you see that if we add that 65,000 and that 50,000, it's 115,000, right? That means that both those prepaid expenses, like you won't remove them, because you charge the thing on the aggregate. That's what they mean when they say the aggregate 100,000, right? Aggregate of all remaining prepayments. That's what that standard means there. Okay, so that 65,000, it's going to be included as a deduction. So it's going to be included as a deduction. So so I'm just gonna use the sections. You can say it's prepayment. So 65,000, then it's going to be included as a deduction. So 65. Yeah. And then yeah, also the security fees, you also want to remove them according to this section, right? Yeah. And then you said 18,000 per month, so 18,000 times 4, that's 72,000. Yeah. Let's see. July, August, September, October. July, August, September, October, November. I think it's 5 months. Ne? Yeah. July, August, September, October, November. Yeah, it's 5 months. So 5 times 18,000, that's 90,000. Sorry, it's 5 months into the year, but it's still within that 6-month period. Okay. Those are the two expenses you're gonna have, but don't forget to remove the accounting ones. So you're gonna remove the same amounts, but for accounting, because don't forget if like the amount. So you see for accounting, the rent income is the same, even in the wedding, the rent income is the same. So even if these two amounts, so even if these two amounts, ne, these two amounts are the same for accounting purposes, so for accounting and tax. However, the way they're included, like it's different. You see here it's included in terms of like a prepayment, whereas like in accounting it's just a normal expense, right? Even if it's a prepayment, it's a normal expense, right? So because they're included differently in accounting and tax, you have to remove the accounting portion and include the tax portion. Ne? The reason why I'm saying this is because if also they give you, let's say, depreciation and they say it's 10% and they say wear and tear is also 10%, don't make the mistake of saying just because depreciation and wear and tear is the same, you don't remove the 10,000. So you're gonna say remove 10,000 of depreciation and include that so basically add the 10,000 for depreciation and remove for wear and tear. Oh, okay, there's a question from Sipoga. So are we not supposed to start on June, since it's the 1st of June? Okay, the reason why I didn't include that June amount is because June is still within the year of assessment. So what's going to happen is that those security fees, so those security fees, you are going to include normally. So for tax and accounting, it's going to be normal because it's within the year of assessment. It's the same as those that insurance premium, that those 2 months. It's the same for tax and accounting. That's the reason. Okay, I'll repeat the insurance transaction again. Okay, so let's repeat the insurance transaction again. So let's look at this insurance premium, right? It was paid for a period between 1 May 2022, right, to 30 April 2023, right? So do you see that this payment is for 2 months in this year of assessment, because it's for May and it's for June, right? So that 6.5, so that's 6.5 times 2, that 13,000 is going to be the same for both accounting and tax, because they are going to remove the insurance premium as an expense, right? That's where we start. So there you're going to write your insurance, so insurance premium 0, but put a reason as to why. Is because the accounting and tax treatment is the same, right? And then for this year, the insurance premium for that, like the insurance premium relating to accounting for this year, you're going to remove that 65,000 for accounting by adding it back, because they removed it as an expense, right? So you're gonna say insurance premium plus insurance premium. Let me just type it down. So insurance premium. So you're just gonna say that insurance. So that insurance so premium, right? So that insurance premium, you're just going to include it as 65,000, right? Because like I said, even though accounting included the 65, so what is the 65,000? Okay, before I continue, what is the 65,000? Let's look at the months from June up until 30 April 2023. It's July, August, September, October, November, December. So it's 6 months. Then so it's 9 months. So we are going to say 6.5 times 9. Oh yeah, it doesn't give us 65,000. It gives us 5,500, right? Because it's July, August, September, October, November, December, January, February, March, April. Yeah. Now it's 10 months. It is 10 months. Yeah, it is 10 months. So it's 65,000. It's 6.5 times 10, which gives us the 65,000. And then here, you're going to remove it via section 23H, but I'll explain it again. But you're going to deduct 18,000 since it's for 6 months, right? Oh no, you see, when you're looking at prepayment of expenditure, you're looking at the entire amount of the prepayment, right? You're looking at the entire amount. Those services for the entire amount, they have to relate to 6 months within the year. So you're not going to only consider the ones that like are after like 6 months. It's the whole entire like insurance premium, because those services, you're not receiving them for the so for, you're not receiving those services. So it's for the entire insurance premium, right? And then then this 90,000 you included. This 90,000 is basically, this one, like I said, is the prepayment for the security fees. So the prepayment for the insurance premium includes the entire amount, because the services are not provided within 6 months of the entire amount. That's why 65,000 for both. Then this is the prepayment. So even for this 90,000, you're gonna have 90,000, but for the security fees, and then include this 90,000, because accounting and tax, they accounted, even though they accounted for the same amount, they account for it differently. This is a prepayment in accounting as a normal expense. Okay, we can continue. So that's 7.1, and continue to 7.2. So 7.2 says
Sorry.
JJ, yeah,
Can we use the mic?
yeah,
Oh, I'm sorry. I just want to be clear on the 90,000. So we don't include the 90,000 as part of our taxable income as a deduction. We just show it that this is how you calculate it for disclosure purposes, that post 6 months after the financial year ended, we calculate it, but we don't include it because it seems like you're only including the 65 and not necessarily the 90,000. Can you just
okay,
clarify?
okay, okay. You are right there. We do include the 90,000. I just didn't type it here. We do include the 90,000. So you're going to say security. So you're going to say the security fees. So security, so for the security fees, you're going to include the 90,000. So for the security fees, since it was recorded also for accounting. Did I answer your question?
Oh, yes, you did. Is it okay if I go back a bit? There's a question I have.
Okay, okay, it's positive here. Yeah, you can go back a bit.
There's a question over here. I think it was an improvement
Yeah,
of a building. There's that rule that says on improvement we multiply by 55%. Do you remember that rule? So I just want
yeah,
to be sure.
yeah.
Why didn't we apply that rule here?
The rule for the 55%.
Yes, sir.
Okay. Um, okay. The rule for the 55%, it says part. So that rule is for part of the building, right? So let's check. can I get back to you? I have to go to the standard for that. I have to check that on the standard. I have to check that on the standard. I'll get back
Okay,
to
no
you.
problem. We can
Yeah.
proceed. Thank you.
Yes. I'll get back to get back to you with that one. However, like for this one, I'm saying for this 90,000 one for the fees, ne, this is a positive 90,000. So please ignore this 90,000 is positive. And then with regards to the improvement, yeah, I'll also check that one out. I'll check that on the standard, and I will also include it in the email that I'm gonna send. Okay. Um. Okay. 7.2. It says JJ does not apply IFRS 9, and the accountant passed the following journal entry. Right. So this is another question that you have to look out for. So you know that for both tax and accounting, we calculate allowances for doubtful debt, right? However, the way we calculate doubtful debt for accounting and for tax is different. And so the way we calculate this doubtful debt for accounting and tax is different. So because it's different, you have to remove the entire accounting amount and then include the like the tax rule. So include everything to do with exclude everything to do with accounting and then include everything to do with tax, since these two amounts are not calculated the same, right? So the first thing you're going to do is we are going to add that provision for bad debts, right? Because it was subtracted. So we're going to add back that provision for bad debts expense, right? The accounting one, the 31,000, right? And then what's the rule for provision for bad debts? It says if IFRS 9 is not applied, right? I have it even here. So if IFRS 9 is not applied, so this is the standard. So IFRS 9 is not applied, um, right? You use what? So you're gonna check the number of days. If IFRS 9 is not applied, you're gonna check the number of days, right? You're gonna check the number of days that are firstly more than 120. Yeah, so if it's more than 120 days, you use 40%. So you're gonna say 40% of that. So you're gonna say 40% of 29,750. So 40% of 29,750. And then you're going to look for debt that's more than 60 days. So that starts way on the second point, right? So you're going to add the 37,000. You're going to add the 37,880 for the bad debts between 60 and 90 days, plus the 34,000 bad debt between 90 days and 120 days, right? Because it's more than 60 days, but less than 120 days. Do you see? After adding it, you multiply by 25%, and then that's going to be part of your doubtful debt. So that plus what you got when you say 29,000 750 multiplied by 40%, and that total, so it's 29, the total is 29,995. That total, that's your doubtful debt. Do you see that amount is way different from the accounting amount? That's why you have to add back the accounting amount and then remove this doubtful debt. Then let's move on. The question says SARS allows a provision of SARS allowed a provision of 25,000 for their 2021 year of assessment, right? Okay, so where do you want me to repeat? Where do you want me to repeat the okay, I will repeat the 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 provision again. The okay.
I think it's the bad debts part because we heard you when you say we take the 29,750 multiplied by 40%. But
Yes.
then which two did you explain that we need to add it to that amount? That's where I think I'm getting lost as well.
Okay. Okay. So this is how you start, ne? So with that one, you're going to start firstly with 120 days. So you're going to firstly look for debt that's outstanding for more than 120 days, right? We said it's this 29,750 multiplied by 40%. So let's do it. So it's 29,750 multiplied by 40%, right? Then we get 11,900, right? Then this amount you're going to say, okay, let's go down. So that's the first step we do. And then what we do is we said what is outstanding, what are the debt outstanding for more than 60 days. So we're going to look for debt outstanding for more than 60 days, right? And it's those 2 points. It's 60 days to 90 days and 90 days to 120 days, right? So we are going to take that 37,880 for the debt between 60 days and 90 days. Because why? That's greater than 60 days, because you want debt that's greater than 60 days, right? Plus 90, so the plus what? 34,500. Why? Because it's debt between 90 days and 120 days, which is what? Still more than 60 days. That's why we start with 120 days, because we want to deal with 120 days first, and then anything that's higher than 60 days that we haven't dealt with, we include in this calculation. That's why we start with 120 days. And then after, so we say 37,880 plus 34,500, right? And then that gives us 72,000. So it gives us 72,380, right? And what do you do with that amount? You said multiply. So we say multiplied by 25 percent, right? So it's multiplied by 25%, and that's 18,000. So 18,095. Yeah, that's the answer. And that answer you add it to this one. You add it to this one here, and then that's where you get that's how you get the 29,995. Yeah, that's how you get the 29,995. Um, I hope that was clear. Okay. Um, okay, we move on. Then it says SARS allowed JJA provision of 25,000 for their 2021 year of assessment. So this is another tax rule. So in tax, what happens? Tax is going to give you a provision for bad debts for this year. You're going to calculate it normally. However, you have to remove last year's one. Don't forget to remove last year's one. So we have to add back this 25,000. We have to add it back. Again, we remove this one. This is the deduction, but we have to add back last year's deduction. So don't forget, when you're doing doubtful debts, don't forget to add last year's doubtful debt. Add back last year's doubtful debt. Okay, so the 11,900 comes from the 29. So it comes from 29,000. So that 29,750 times 40, 40%, times 40%. Because why? For debt greater than 120 days, you use 40%. So for debt greater than 120 days, you use 40%. And then for debt greater than 60 days, you use 25%. Yeah. And then that's 7.2. So that's 7.2. Then can move on to 7.3. So for 7.3, so the first thing is for trade debtors, bad debt is going to be the same both for accounting and tax purposes. You're going to remove it for accounting. So for accounting and so for both accounting and tax, you're going to record it. So there's not going to be any movement. There's going to be a zero, and then explain it's because of the same accounting treatment, right? So it's either you can put zero, or you can just do just reverse the accounting and put the tax, even if you can do that. Yeah. And then for the personal loan to the employee and the interest to the employee, um that one is a suspect trade, because we are giving a loan to an employee. So that's a suspect trade. So that one wouldn't be included. That bad debt wouldn't be included. That one. So you have to add it back. So we have to add back that bad debt for the employee. However, I'll double check in the standard. I just checked in the standard. They said it's a suspect trade matter. I will double check with my coordinator with this one, and I will email you the answer. Yeah. Then so for the personal loan to the employee and the interest to the employee, because that's the interest from that loan, those ones you're going to add back because accounting removed them. It's suspect trades. But like I said, we're going to double check because I just checked it in the standard. Okay. Then 7.4. 7.4, it says legal expenses were incurred during the year. JJ's lawyers. So JJ's lawyers send an invoice representing fees charged for legal expenses incurred in attempt to collect long outstanding debts during the year, right? And they said it's for 4.5 thousand. So it's 4.5. So let's see how this thing has to be accounted for. So for tax, legal expenses, what do they say? This is the so the principle for legal expenses, section 11C. This is how it goes. Yeah. That's the easiest way to remember it. Legal expenses are always for something, right? So there's a dispute for something, right? Now, what you have to do is just look at the dispute. Look at the dispute. If the dispute, whatever happened in the dispute, is recorded in gross income, so in taxable income, then that legal expense, like you're going to put it, like you're going to deduct it, right? Why? Because it's legal expenses done for for in production, so in carrying out a trade. That's why. So you're going to look at those legal expenses and see whether what happened there like affects taxable income. So let me show you what I mean. So here they said JJ's lawyer sent an invoice representing fees charged for legal expenses in carrying to collect the long outstanding debts, right? So they mean these days. Do you see that the trade debts are in the taxable income, right? So because trade debts are in the taxable income, you're going to have that section 11C deduction for legal expenses of 4.5 thousand. So you're going to say legal expenses 4.5 thousand for that one, and then don't forget accounting did account for these legal expenses to remove the accounting portion for it. So you see there's two ways you can do this, and I know I've been using the zero way. So if these two accounts are the same, use zero. But the easiest way to approach this is that remove all accounting things and then put tax so what tax wants. So remove all accounting rules and put what tax wants. That's easier. That will make sure that you get all the marks. Otherwise, you will forget like the accounting part. Remove the accounting part. So just from the get-go, when you start with every point, remove its accounting portion and then put what tax like supposed to put in. So even things like rental income, even though you know that rental income for tax and accounting is the same, just start by saying you're removing the rental income from the accounting part, and then you're putting in the rental income for the tax part. That will help you in terms of like answering every question the same. So yeah, do it like that way, and I'll also continue that way. Okay, so 7.5, it says the following journal entry is in relation to the machine list as described in note 6 above. So JJ rented a manufacturing machine for use in the new factory, right? Do you see that now you know the section for repairs is section 11D, right? So that's for repairs, right? So now we have to firstly so for repairs, what does that section say? Those repairs, so those specific repairs, as long as that asset you are using it in the production of income, look at that leased asset. Do you see that that leased asset is a manufacturing machine that you are using in your factory, right? So it's used in the production of income, right? And you are also so you are also using that machine. You are using it in the production of income. So those repairs are in the production of income, so they have to be included as a deduction. So deduction for those repairs, right? So deduction for those repairs for tax purposes, and then remove it for accounting purposes. So include for tax purposes, remove for accounting purposes. Don't forget that rule. Then can move on to 7.6. So 7.6 says contributions to pension and provident funds on behalf of employees amounted to 200,000 for the 2022 year of assessment. So that's a normal employee benefit. Because the normal employee benefit, you are going to deduct it. So the normal employee benefit going to deduct it. So those contributions to pension fund also deduct them. So accounting did deduct them. So don't forget to include the accounting portion and then remove the tax deduction. And then um and remove the tax deduction. Then we go to trading stock. So I'll answer all questions at the end. Yeah? So can move on to trading stock. So trading stock says, so 7.7, it says JJ suffered the following losses due to theft. So trading stock worth 30,000 was stolen by an employee. The amount is recoverable to the extent of 22,000 from the insurance company. The money was not yet received from the insurance company at the end of the financial year. The following journal entry was passed to account for the stolen trading stock. So firstly, do you see that so firstly there was trading stock that was stolen, right? So firstly, SARS is going to give you is going to allow you to deduct that 30,000 for the stock that was stolen. Now the main problem now is this 22,000 from the insurance company, right? So this 22,000 from this insurance company. So this 22,000 for from the so this 22,000 from the insurance company. When do we include it? We include it when it accrued. So when it accrued to us, right? That's when we include it, when it accrues to us, right? So they said the money was not yet received from the insurance company, right? So in this question, they were not really clear about whether it accrued or not. They just said the money had not been received, but they did hint and tell us that the recoverable amount is to the extent of 22,000 because they didn't specify that it was an accrual, but they did hint that the recoverable amount is extended to 22,000. We will assume that they did it did accrue, because they did tell us the recoverable amount and they just said the money was not yet received. So we're going to include that 22,000 for the so from the insurance company, right? And then we move on. It says a director embezzled 180,000. The amount is not recoverable under insurance contract. Ne? So this one is a corrupt activity. Ne? So and for corrupt activities, like there's no deduction. So for fines and like things of that nature, there are no deductions. So this one, do you see that this one it's a corrupt activity, and it's also proved by this insurance company. Do you see that they say the amount is not covered under insurance contract? Insurance contract do not there is no insurance contract for corrupt activities, right? But do you see for the first one there was an insurance contract? So that employee, so the way they are looking at that employee is not really is not really the entity, right? But from the director's point of view, the director is like the entity because it's corrupt activity that are done by the entity, right? So the director is in a much more direct position to be classified as the entity, as because his decisions are directing the entity, right? So they are the entity basically. So when a director makes decisions, they are directing the entity. So their decisions are the decisions of the entity. So do you see that they say the director embezzled 180,000, right? And the amount is not recoverable under insurance contract. Like I said, insurance contract will not insure you for a corrupt activity, right? So you do not include this deduction. So what you're gonna do is you're just gonna reverse, because accounting did remove this. You're just gonna reverse the accounting entry. Yeah, and then we move on to 7.8. So 7.8, it says the following expenses were incurred for advertising. So that's radio advertisement and a permanent billboard erected next to the so firstly it's a radio advertisement. So that one, the radio advertisement, definitely it's an expense. We are just going to deduct it, right? And then the billboard that's erected, right? So the billboard that's erected, they didn't tell us basically when this, so they didn't really tell us when this billboard, like so this billboard does not function as a okay, yeah, I'm going to have to look at this billboard more, because it's it can be a capital asset, right? Because this company is going to use it for like for a while, since they said it's a permanent billboard erected, right? So going to have to check again in the standard whether this thing must be removed. So just mark it for me. I will send you the email. I will send you the answer via the email. Okay. Um. Okay. And then that's question one. So do you have any questions in terms of before we move on to that income tax? Okay. I think we can move to the VAT part. Okay. Let's see.
Can I ask something?
Yeah.
I just want to know the rule for lease improvement, isn't it that 300,000 one, or am I mistaken? There's the one that says it's either 300,000 or the things I'm forgetting where my notes are. Because I'm not sure how you got that amount today. I was not
Oh,
in
okay.
the session.
Okay. For the lease improvement, ne? So for the
Mhm.
lease improvement, what happens is the standard says you use the contract stipulated amount, right? First. So what you're gonna do is you're going to look for the contract stipulated amount. You'll see in that question they said the lease improvement were to the value of 55,000, right? However,
Mhm.
the contract stipulated 70,000. So you're gonna use the 70,000, what the contract stipulated, as the lease improvement. And then now you're going to calculate the relief after that. So after that, you're going to calculate the relief. And what is the relief equals to? The relief is equals to the leasehold. So the leasehold that you have right now. So that's 70,000, right? That you have right now, minus present value of that lease discounted to 6%. So that present value amount that they gave you, you minus it. That's going to be the relief for the lesser. That's the relief
Oh,
for the lesser. Yeah, that's the relief for the lesser. And you see that so that discount, that amount, that 30,000 was discounted for 10.5 years, for that lease term, right? So it's a relief for the lesser. Why is it a relief for the lesser? It's mainly because think about it properly. So if the lesser, so the lesser is listening to the lesser is listening to the lessee, right? But the lessee during this 10.5 years is still in that property. So he's still in that property, he's still using that lease. So do you see that those 70,000 improvements, the lesser is not yet enjoying those benefits of the 70,000. He's not yet enjoying them, because the lessee is still staying so it's still leasing that particular property, right? That's why, like, they're gonna give him a relief. SARS gives him a relief based on the number of years, so it's 10 years. So they're gonna use that 10.5 years times 6%. I'm just giving you this if in a question they don't give you this calculation. So you're
oh,
gonna use the 10 years to calculate the PV. So it's for the term of the lease, but 6%. Every time the amount is going to be 6%, then you calculate the present value of that amount. So the future value is the contract stipulated amount, and then you calculate the present value using that. Yeah.
oh, well, I thought maybe you used that. I think I wrote it here.
Mm.
It's limited to 25 years or not more than 100,000.
Oh, that's lease premium. That's, you see, that's
Oh,
lease premium. Yeah, that's lease premium. So yeah, lease premium, you're going to divide by the number of years of the lease term, limited to 25 years. Yeah, that's for the lease
oh,
premium. Yeah.
Okay, I'm sorry to take your time, but can you repeat that thing because I was confused where you're getting all those information. So you said to me I should take the 70,000 because it's
Yeah,
you use the contract amount,
yeah,
contract stipulated amount,
yes.
and you less the present value. So the
Yeah.
present value is
So now let's
6%.
okay, before you go there. So firstly, for the leasehold improvement, it's 70,000. Use the contract stipulated amount. Now let's calculate the relief. The relief is it's a different. Now you are done with the lease improvement. You are calculating the relief for the lesser. This is something different. Ne? The relief for the
Okay.
lesser. So for the relief of the lesser, the first thing you're gonna do is you're gonna look at your lease improvement amount. What is that amount? It's 70,000, right? You're gonna use that amount first. And then you're going to say that amount minus the present value. The present value, yeah, that present value, yeah, discounted to 6%. Yeah. And then that's the relief for the lesser. Yeah. And then what's going to happen in your taxable, so in the statement, you are going to have your lease. So you're going to have your leasehold improvements as 70,000, then minus your relief for lesser. That's how it's going to look.
Okay, no, I see. It makes sense. Let me just ask one more, then I'm done.
Okay.
There's the part about the van, the delivery van.
Yeah, delivery
Uh,
van. Okay.
so it's an asset, number one, and
Yeah.
according to me, I would use the section 11E, the one where you apportion. Am I
Yeah.
correct?
Yeah, you're right. Correctly.
Does it also account for the clocking machine as well? Is it also section 11E?
Yeah,
Because
it's
it's
section
also
11E, yes. But for the clocking machine, you're going to put the total amount. You're not going to use the 5 years. Why? Because it's less than 7,000.
oh,
Yeah.
okay.
Yeah.
Also, in what case where you use the 12C, where you use the 40-20-20? I know it's
It's
40-20, it's new or secondhand, but is it what? Is it machinery?
yeah, it's
What is it?
machinery, it's manufacturing machinery. So that
Oh,
manufacturing is very important, not just machinery, manufacturing machinery and plant. So manufacturing machinery and plant.
thank
That's
you
where
very
you
much.
use, yes. And sorry, and aircrafts. So if they put aircrafts, you use also section 12C, aircrafts. So if
Thank
they,
you.
yeah, yeah, okay. Let's see the next question. So 7.8. Let's look at 7.8. So yeah, 7.8, we deduct the radio, ne? So the radio you're going to say 20,000, deduct the radio, and then include it for accounting purposes, right? However, for the permanent billboard, I said I'm going to just check the standard again because I'm not really sure with that one. Yeah. So
Sorry, can I please also ask regarding 7.7?
okay.
Do you hear me?
Yeah, I can hear you.
All right. So annuity since stolen or damaged stock may be deductible for income tax purposes if the loss is not recoverable from an insurance claim.
Yes.
Since here we lost 30,000 of the
Yes.
stock was stolen, but only 22,000 is recoverable. We
Yes.
don't consider the 8,000. We don't do anything about the 8,000.
No, because we already, so we included 30,000 and removed the 22,000. So we
Oh,
included that, yeah, we included 30,000, and so we said 30,000, right? Minus 30,000,
yes.
and then include the 22,000 for the insurance.
Oh,
Yeah,
all right. Thank you.
yeah. Then yeah, like I said, the permanent billboard, I'll look at the standard, and I'll also look at the standard for the improvement, like the that 55% rule. I'll also look for it and then send you the answer via email. Any other question?
Hi.
Hello?
Can I ask?
Yes?
Yes. You said I think you were explaining my improvements. Ne? Are
Yeah.
we not using the lower of market value or cost, since gune contract stipulates 70,000, the market value is 55,000.
Oh no. For leasehold improvements, like you use like the standard says. The standard says the first thing you look at is the contract stipulated amount. That's what you look at. And then
That is, sorry, that is number 3, right?
Sorry?
You are explaining number 3.
Let me, I'm explaining number three. So you see the contract stipulated amount is 70,000.
70,000, yes.
Yeah. So you're going to use this contract stipulated amount. Let me just open the textbook. I want to also show you another example in your textbooks. If you have your textbook, I just want to refer you to the page with this example. So so with this very example, let's go to, so this is leasehold improvement, and leasehold improvement is an inclusion, so 59. Okay. So okay, sorry for this. Just want to look for the leasehold improvement. Yeah, so the leasehold improvement. Okay. Go to refer to page, so page 71. Page 71 will also give you another example for this leasehold premium. You'll see what I mean. Because in this question, what happened? They said in terms of
under which bullet?
So it's the example leasehold improvement. Page 71, example leasehold improvement.
Okay.
Yeah. So if you read the question, I'm not gonna read the entire question, but the gist of it says, in terms of the lease agreement, right? So in terms of the lease agreement, in the contract, what did they stipulate? They stipulated that they're gonna pay 8 million, right? For that thing, 8 million. However, do you see that they said also OP decided it was also a great idea? Okay, so OP, that other entity, it also discussed with the lessor that they want to so they're going to want to effect improvements of 12 million, so not 8 million anymore, 12 million. However, they just discussed it, right?
Oh,
It wasn't stipulated in the contract. Do you see?
The contract.
Yes. However, do you see, look at the amount that was put into gross income. Do you see it's that 8 million, the amount stipulated in the contract. Yes, so that takes precedence.
Yeah.
So amount stipulated in the contract. Yeah.
Yeah, but it may be Uguti 8 million is lower than 12 million. That's what I'm asking Uguti. And it's what we use the lower of market value or cost. So even let's say maybe the amount stipulated in the contract was 13 million, and the cost of the final improvements were 12 million. Were we gonna use the 13 million stipulated in the contract or the 12 million, which is lower?
Yeah, according to the section I wrote, we are going to use the contract stipulated amount, but I will check what you are like. I will check it again. Like I will check it again and give you an answer in the email I'm going to write. You're going to review it again. So we're going to review it again. Yeah, going to review it again.
Yeah, because I think there's somewhere where I read to we're using the lower of market, which I made a note somewhere. So I'm referring to that note, not the actual page.
Oh, okay. I'll refer back to the standard, but so far, I'm reading the standard right now. It says use the contract stipulated amount. It said use the contract stipulated amount. So far, get that principle of contract stipulated amount until I tell you that it's another rule, because it has to be in the standard for that to apply. It has to be in the legislation. So I'll look for it. And then any other questions? So okay, 7.6. Now did account for 7.6. So for 7.6, it's a normal deduction, because let me see. Yeah, 7.6 is a normal deduction because it's contributions to pension fund and provident fund, right? So it's the same. So what's going to happen is that for tax, you're going to have a deduction, right? You're going to have a deduction, and for accounting, the accounting did already reduce it to 200,000. So you're going to add it back add back the accounting 200,000, remove the tax 200,000. But it's a normal deduction. Yeah, because contribution to pension funds on behalf of employees for the employee is just an employee benefit. You are just paying the employee there, but you are paying them via contributions to pension funds and provident fund.
I'm sorry, can I please also ask regarding 7.7 where a director stole the 180,000 and is not
Yes.
recoverable?
Yes.
How do we account it?
Okay. For that one, for tax purposes, there is something called corrupt activities. So if that
Yes.
activity, if an entity participates in corrupt activities, then that amount will not be deductible according to tax. So if it's a fine, do you see also the director embezzled? And like I said, the director is closely linked to the entity, right? So whatever the director takes, so the decision the director takes is the decision that the entity takes, right? So because
Okay.
the director embezzled the 180,000, right? That amount is not deductible. So it's a corrupt activity. It's not allowable. So for tax
So
purposes,
it's more like it is not part of trade.
yeah, it's not part of trade. It's not part of trade. It's not in the production of trade. So it's not in the production of income. So what's going to happen is for tax purposes, you won't have a deduction. However, don't forget to include it back for accounting because accounting did deduct this. So you include it back for accounting. Yeah.
All right, thank you.
Yes. And then okay, I think we can start with tax VAT. I mean VAT. Can go to VAT.
Sorry, I think I found where I was asking.
Okay.
Bullet 5, page 71, bullet 5.
Bullet 5, page 71.
Yeah.
Okay. Let me go to bullet. Okay. Bullet 5, page 71. So in page 71, I see relief for lesser. Where exactly? Is it page 71 or page 70?
I think it's 70, yeah.
Okay.
70.
Okay.
Number 5, it may happen.
It may happen that the actual cost of the improvement exceed the stipulated amount in the contract. Okay, it may happen that sometimes the actual amount of the improvement exceeds the stipulated amount in the contract. This was okay where the court found that the lease agreement. Okay.
Hi, can I please add something to what he's saying?
Yes.
I wanted to say, like, for this question, right? I need to 4.5. It says that it may happen that the actual cost of the improvement exceeds the amount stipulated in the contract. For this question, the actual amount of the improvement didn't exceed the amount stipulated in the contract. Hence, you were
Yes.
saying the amount stipulated in the
In the
contract.
contract. Yes.
Yeah.
It didn't exceed this amount. Let's see.
So hence, the amount stipulated in the contract. You don't have to use the lower of market value because it didn't exceed.
Yeah. Okay. However, may I please also I want to find that also in the standard. So I'll also look in the standard for that. Especially for this rule, the lower of the market value part, like when do you consider it? Mare, what I know, according to the standard that I'm reading right now, it says when you're given the contract stipulated amount, the precedent is you use that amount. And then if you're not given that amount, that's where you consider the lower of market value and all of that. But I'll look through the standard again. Yes, like you said, yes. Like you said. Yeah. And okay, thanks for that. Okay. Let's I think we can move on. I'm going to just do the text in AO2, text in AO2 because that's the one I prepared for. So that the text in AO2. If you guys want a video on the VAT question that you did on the exam, so the VAT exam question that you did, just text me text me personally there, and then I will do the video for you. Yeah. So I'm moving to AO2, AO2. So AO2, the question paper you wrote, AO2. So May, the May 2022. Yeah. The May 2022. Okay, I'm gonna give you a minute to go get it. Okay. Okay. I think we can continue. All right. Um, I'm starting on question one. So question one, Milky Treats. So Milky Treats. So Milky Treat is the vendor. Okay, let's look at the required first. So the required says prepare journal entries to record for the information of Milky Treats for the tax period ended January 2022. So for the tax period ended January 2022, give clear reasons for any tax effects in your answer through the narrations, right? So they want us to prepare journal entries. So think of both accounting and tax. So they seriously like want accounting journal entries here where you account for VAT input, but you also accounting for VAT input and VAT output, but they want journal entries. So let's start. So Milky Treats, we are Milky Treats. So Milky Treats is a South African resident company. Okay, Milky Treats is a registered value added tax vendor. So it's a registered vendor that makes 100% taxable supplies. Now let's first pause there. That 100% taxable supplies. Okay, I think on your level they will always tell you about the 100% taxable supplies. So I won't delve deep into it now. Then they said it has a financial year that ends on and has the financial that ends on the last day of February, right? Then it says Milky Treats manufactures chocolates for the local and international market. So do you see that's something also to note? So they are also selling to the international market. So they are exports. Ne? Do you see? They're selling to the international market, so they're exports. Then Ellen and Jane, both South African residents, started the company in 2002. They are equal shareholders. Ellen is the managing director and Jane is the financial director. The company's offices and factory are situated in Kempton Park, Gauteng. Milky Treats is a category A VAT vendor. Now, this is very important. It's a category what? A VAT vendor. That means that if they said calculate the for the period ended for the tax period, what do they mean when they say tax period? They mean VAT period, right? Because that's the tax. What's the tax is the VAT. So for the VAT period ended January 2022, and they said he's a category A VAT vendor. You remember for category A VAT vendor, it ends barely January. So but it's 2 months every time. So it's for January and December. So you have to record things for January and December. That's your year. That's your period. It's from 1 December 2000 and, from 1 December 2021 up to 31 January 2022. That's your period. That's your VAT period. You see, it's very important, like I said, to know your perspective. I'll go back to MM approach and show you what I mean when I say it's very important to know your perspective, because if you don't know your perspective, you can get lost. So like we said, who are we? We are Milky Treats, right? At least we know the person, we know we are the company. The date we know now the date is January 2022. We know the financial year. So knowing the financial year, like I said, it will tie everything into perspective, right? So let's say they give you in this question an adjustment that relates to, let's say, November 2021, or it related to October 2021. It was not going to be part of this VAT period because it is not part of the tax period. You understand? So it's very important to know what period you're working with. That's why I'm saying dates are important. Who are you? And the year of assessment is very important. So have that first before you start with your question. Okay. Then can move on. So you are assisting Jane with the income tax and VAT treatment of certain transaction for the VAT period ended January. So for the VAT period ended January 2022. The following information relates to this period. All amounts include VAT where applicable, unless otherwise stated, right? So we're told that all amounts include VAT, right? So let's start with the first one. The first one says local credit sales of 575,000 were invoiced. Now, the first thing you had to note there is local. So it's local sales. So it's sales in South Africa, in our resident company, right? In our resident, I mean, country. So what's going to happen? Because now, let me explain VAT. This is like the main principle of VAT. VAT is going to tax you. It's going to tax you based on where you're going to consume those supplies. So where are you going to consume those supplies? If you're consuming them in South Africa, they are going to tax, like they're going to tax you VAT. But if you're consuming them, you're not consuming them in South Africa, you're not going to be taxed VAT on that supply. So you see with this one, local sales, they are consumed inside the republic, right? Inside the country. Therefore, in this amount, this 570 amount, because they said all amounts include VAT, that amount included VAT, right? So the first thing you're going to do is, now, what's the structure of the journal entries? How are the journal entries going to look? So the first thing we know that we have revenue, right? So revenue, we are going to credit, right? And then what are we also going to credit? This is a sale, right? We are receiving money. So it's VAT output, right? So VAT output, we are going to also credit, right? And then we are going to debit receivables, right? Because it's a credit sale. So debit receivables. So we're going to debit receivables with 575,000, right? And then you're going to say output tax. So how are you going to calculate that output tax amount? By saying 575,000 multiplied by 15, which is what you want. You want the VAT over what you have. What do you have? You have the 115, the amount including VAT. That's how you get the 75,000. And then for the sales, you can say again that 575,000 multiplied by what you want. What do you want? You want the 100%, right? Over what you have. What do you have? You have the 105. 105. So it's going to be 575,000 multiplied by 100 over 115, which gives you 500,000, right? Then, so the total general entry is accounts receivable. You're going to debit with 575,000, credit output tax with 75,000, and then credit revenue with 500,000, right? You'll see in some of your questions they use sales. You can use sales or revenue, it doesn't really matter. Then we continue. Then number two. So number two, what is the so for number two, what is the, so number two says a cash sale of 1.5 million was made to a company in Nigeria, right? So I don't know, can you still hear me? Because this side there is no electricity. Can you still hear me? Can I get a response?